Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be doing a brief stock analysis on Lowe's company, ticker symbol LOW. So first of all, we're just going to look at some of the earnings results and releases from the second quarter of 2021. This was released about a month ago on August 18th, and this accounts for the quarter ended July 30th, 2021. So that's basically May, June, and July for Lowe's. And basically, as you can see, they say they reported net earnings of $3 billion and diluted earnings per share of $4.25 for the quarter, which is compared to net earnings of $2.8 billion and EPS of $3.74 in the second quarter of 2020. So that's a pretty nice jump there. And they say that total sales for the second quarter were $27.6 billion compared to $27.3 billion in the second quarter. And also, 100% of Lowe's stores this quarter earned a profit sharing bonus, which resulted in $91 million paid out to frontline hourly associates. And it says this payment is $20 million above the target level. So that's pretty cool that they have a profit sharing program, and they're paying out, some money to those workers that are working hard to support them, also paying out dividends to their shareholders and stuff like that. So they also talk about, actually how they're increasing shareholder value here with capital allocation. So it says that during the second quarter alone, they purchased 16.4 million shares for a total value of around $3.1 billion, and they paid about $430 million in dividends. So right there, around $3.5 billion in that quarter alone in the second quarter returned to shareholders. So that's pretty nice. And they do talk about their stores. They say at the end of July, they operated 1,973 stores in the US and Canada, which represents 208 million square feet of retail space and serves approximately 230 dealer-owned stores. And they also give some financial outlook for the full year of 2021. So they say they're shooting for a revenue of about $92 billion, or estimating that. So they're shooting for revenue of about $92 billion, which would represent approximately 30% comparable sales growth on a 2-year basis. And they say that their gross margin rate will be up slightly compared to the last year. Operating income as a percentage of sales should be around 12.2% for the end of 2021. And they hope to have a minimum of $9 billion in share repurchases. And they expect capital expenditures of approximately $2 billion. And then down here, they have some nice, tables and charts with some of the earnings. Let me zoom in a little bit. It's a bit hard to see, but some of these numbers we already went over. Total sales around $27.6 billion compared to last quarter around 27.3. And then also for the 6 months of the first quarter there, or the first 2 quarters of the year, their sales were about $52 billion this year and only around $47 billion last year, so a nice increase there. And their margins around 34% this year for this quarter compared to 34% last year, so a tiny bit lower. And then similarly for the 6 months, their gross margins are about the same, about 33.5%. And then also looking at earnings, like they said, around $3 billion in earnings this quarter compared to $2.8 billion last quarter. And so far this year, they've raised about $5.3 billion in total earnings compared to only $4.16 last year. So a nice increase there. Their dividends, as you can see, is about 80 cents per share just in this quarter, and that is pretty crazy because last year in the second quarter they only paid 55 cents per share. So doing some quick math, that's like, I don't know, pretty close to a 50% increase, I think. So that's pretty amazing to see. And also I love it when they show a little bit of balance sheet action here in this earnings report. So current assets sitting around $25 billion right now, which is a little bit lower than last year, around $27 billion. And again, this trend I've been noticing is that they just have a lot less cash right now, around $4.8 billion of cash right now compared to 11.6 last year. So a lot of companies were just kind of sitting on some cash around this time last year. They were just uncertain of the future given the pandemic. So at least from my assessment, that's the general reason that a lot of these companies have current assets that are a little bit lower than they were last year, which is actually a little bit surprising. And then current liabilities, though, are around $21.6 billion, which is pretty much in line with where they were at last year. And that's pretty good to see because they're about $4 billion below, $3.5 billion below the current liabilities. So they have a current ratio probably around 0.95, 0.9 there. So that's pretty healthy because they're definitely, leveraging some of their assets, but at the same time, they still aren't over leveraging, certainly, because that current ratio is less than 1. And then comparably, the total liabilities, total assets here is around $49.4 billion, while the total liabilities is actually a little bit higher at around $49.57 billion. That actually means that the total shareholders' equity is a little bit negative, which is something you don't really want to see, I don't think. They do have some debt here of around $22 billion, which is a little bit up from last year. And, it's not the worst thing in the world, but I really would like to see some of that be taken care of. I mean, really not, like anything awful by any stretch of the imagination. But you would like to see those total liabilities a little bit lower, just to have a little bit healthier balance sheet there. And looking at the dividends right now, currently their dividend yield is around 1.57%, which is, on the low end for dividend paying companies. But their payout ratio is also very much so on the low end, around 28%, which leaves them a ton of room to grow that dividend. And they have been growing that dividend a fair bit, around 16.92% on average over the past 5 years. And they have also been growing that dividend for a very long time, around 58 years. That means they are a dividend king, which is a pretty great status. And we're also going to take a look at the dividend history just to look at when they do increase that dividend. So it looks like they increased that dividend between the second and third quarter. So they announced that dividend, at the end of May there, and then they paid that dividend at the beginning of August. So we'll probably won't be expecting another dividend increase till around May or June of next year, but that will be super exciting to see, what happens there. And looking at this, it actually gives us a little bit more transparency as to why that dividend increase was so great from 55 cents in the second quarter last year to 80 cents, because they actually increased it twice. As you can see here, they only paid this 60-cent dividend for 3 quarters, and then they increased it straight. And also taking a little bit of a look at the PE ratio, just to try to get a high-level understanding, of some of the valuation metrics surrounding Lowe's. You can see, throughout the 2010s, we're sitting around a PE ratio of 10, 12, 13, up around 20, and pretty steady around 20 there. And then we had a little bit of a spike there, just to mostly due to a drop in EPS up around 36. So that was pretty interesting to see. But right now, the PE ratio is sitting right around 20 at 20.91, which I think is really not bad at all, considering it's pretty much in line with most of the time from 2013 to 2018. So overall, historically, I think the PE ratio looks pretty good. Looking at the stock price, you can see it's been growing pretty drastically over the past few years, and so the reason the PE ratio has stayed pretty constant is because the earnings have been growing pretty drastically as well. So if we do see those earnings, start to falter in the amount that they are growing, then that PE ratio is going to go up a little bit, and we'll probably be expecting a little bit less growth in the stock price in the future. And also comparing this to the sector as a whole, they are in the consumer cyclical or consumer discretionary sector, and they're probably in their retail industry here. So the overall sector average is around 20.69, which is pretty much exactly what Lowe's PE ratio is. So they're pretty much in line with the sector. As far as the industry is concerned, though, the industry's average is right around 16. So Lowe's is a little bit higher than that at 20.9. So that is definitely something to consider. Obviously, the PE ratio is not everything, but compared to the overall S&P 500 market, Lowe's is definitely not at a terrible valuation. Looking at the stock price here over the last 8 months or so, we can see that they are near the top of their trend here over the past 8 months. They did have a nice dip there in March to around the 150, 160 range, which I think was a pretty good buying opportunity. I didn't take it, and kind of wish I did buy some there. either for myself or for my brother in his dividend portfolio. That was definitely a good price, and you can see they just had an amazing rally over the next few months after that. And then they did have some subsequent dips a little bit, but right now they're still, up above the $200 range, which for me I think is a little bit too expensive. At the time, or at this time, I'm really not, trying to add new dividend stocks just to add dividend stocks. I'm trying to add dividend stocks that, are at a good price. And Lowe's is one I'm definitely really interested in because of that awesome dividend growth rate recently. It's just been pretty monstrous, the amount they've been growing the dividend recently, and it's been pretty consistent as well. So overall, I would like to see the stock price drop maybe a little bit below this little bit of a trend line here, so below the 190 or 180 range would definitely be a little bit of a better price, I think. But let me know what you guys think of Lowe's if you do own it, and what price you think would be a good price to buy it at, because this is definitely one I have my eye on pretty closely. So if I see a good price, I would definitely be interested and heavily consider purchasing it. So thanks for watching to the end of the video. I hope you did enjoy it, and I will see you in the next one.